Alright guys, I'm going to keep this meeting today pretty short and sweet. Get down to the point. Today I'm going to be showing you the U.S. Treasury market, its activity, the yield curve, and our forecasted interest rates all the way up for the next 10 years. We are doing the interest rate forecast for the last week, which would be October 21st all the way to October 25th. Just going to go over a little bit about what you will see on here. You will see a weekly snapshot of the U.S. Treasuries and the movement of the yield curve, as well as our forecasted interest rate. What I'll be doing is using the expectations hypothesis to forecast interest rates from now, each year, till 10 years from now. What I have for you right now is the Treasury yield curve. At the top you see it's labeled. Down here we have our time, R1 through R10, and then over here our ask yield. Now you see it's Monday through Friday, of course every day, the 21st to the 25th. At the top, it seems like our week started off pretty high, and then the yield curve began to flatten. So as you see, Monday, and then Tuesday, Wednesday, a little lower. Thursday, we had a nice little spike, so we actually went up, and then fell terribly on Thursday, which even down here at our R1, it was negative, very much negative. Our second graph that I want to show you today is going to be the interest rate forecast and how it's going to be affected. Since the interest rates were low, kind of gives us a little bit of an inverse reaction. For a one-year forecast, as far as our time going all the way up to 2022. Now, I do want to note that we have October values all the way up until 2019. However, the remaining 3 years, 2020, 2021, and 2022, we had to pull from November, primarily because, well, there was nothing maturing in October for those final 3 years. So in order to make our graph complete, we pulled from November. So as you can see, our interest rate forecast, there is a pretty good relationship here. And it shows somewhat opposite what we got. We did in the bottom down there, where it shows Friday's a little bit higher than the rest of them down there. That is because it did start off better. However, when we come up to about here, which would be our 2019 to 2020 mark, we see a pretty large deviation going through. With the large deviation, everything was up, down, whereas Friday, our actual yield curve changed substantially for our Friday forecast, therefore changing our interest rate forecast dramatically, as you can see. Now there were some key factors and events that actually triggered these changes. Some of the more interesting ones are going to be noted right here. The Treasury 10-note yields fell to a 3-month low. Basically since July, we've experienced the low ones this month. Now, that's not to say that it was looking terrible. We did go up. But the primary reason for it being low was when we to our job load forecasts in September. We actually undershot by a pretty large margin. Up here, on Thursday, we actually went up a little bit, as you saw in our graphic correlated with this. We edged up out of our 3-month low because we speculated that the Fed would be buying less. Their recent buying kind of faded. Now, we do have data that does suggest sluggish growth, as of course reported in our job gains being below our forecasts. This would support our view on the Fed stimulus we want to push more money in, stimulate our economy. In order to stimulate the economy, our investors have invested up to $7 billion in our 30-year TIPS supply. And then down here, our Fed is also investing another $1.56 billion in bonds that would be due between 2038 and 2043. I'm going through and breaking down each one of our previous titles. We did have our 3-month low. It was resulted from the payrolls of people that we hired performing less than what we projected in the September forecast. Now, we also showed that the U.S. government and the economy had little momentum leading up to the shutdown. Now, we all know the shutdown lasted nearly 16 days. What this is showing is that the problem lied even before the government shutdown, because we were having much more sluggish growth. Next, you'll see that we edged up, because on Tuesday we were down. Now, on Thursday we did edge up a little bit. Again, you saw the graph that we correlate. The edge up on Thursday is idea of the Federal Reserve shrinking its bond purchase program. We were thinking it was going to shrink its bond program, however, that idea has faded. Our bond market rally struggled to stay below 2.5%. primarily as a lot of the delayed tapering has been priced in. Now, the Fed purchased $1.56 billion of treasuries that matured between February of 2038 and February of 2043, so about 25 years from now. They did that today, which was at the time Thursday, to go ahead and just move more money. Now, there was a sale of $7 billion in inflation index 30-year bonds, otherwise known as TIPS. That was done also on Thursday, October 24th, and that is also where we saw our interest rate go up slightly. And we did this in order to hedge the risk because the Fed, of course, we're always going to have inflation. It's inevitable. So in summary, going through, our yield curve is flattening, making our long-term investments less desirable. Our major impacts against the yield curve this week, of course, we went over them just to recap. We do have, we're edging up from a 3-month low. That was done on Thursday. We did have sluggish growth, which was brought in by our downturn in the economy due to the shutdown. It was also brought on by our job forecasts not meeting where they were projected to be. The Fed buying 1.6 billion bonds that were due 25 years from now. So in short, we see October 21st through 25th, how our yield curve is flattening. So glad you guys are coming out today. I'm glad it'll take this less than 10 minutes of your time.